Good evening, everyone, and thank you for joining us for the student loan webinar hosted by 907 Financial. I am the presenter for the evening, Travis Gallardi. I'm the owner of 907 Financial and senior finance consultant. 907 Financial is a financial literacy group dedicated to teaching people beginner, intermediate, and advanced financial concepts. Our mission is to educate and empower you to find your financial freedom. We work with people in private one-on-one settings and provide group presentations to various businesses and organizations. So why do I care and why did I create a financial literacy group? Well, there's two main reasons. Number one, 64% of Americans cite money matters as one of the top stressors in their life. And in a recent study by Dr. Wang, a renowned psychologist out of Ontario, Canada, she found that financial stressors have the largest impact on attempted suicide, followed closely by violent assault. Number two, the National Financial Literacy Test average in America is 63%. Financial literacy test scores in Alaska is below the national average. At 907 Financial, we believe financial literacy leverages financial behavior. Results have shown that states who have employed a financial wellness program have increased their residents' credit scores by double digits, while their net worth increased by 27%, and sick days from work decreased by 34%. Again, our mission is to empower you to find your financial freedom. So in tonight's webinar, we will be covering the types of student loans available to you. Why do I need to worry about student loans? Do I need a student loan? Help, I have student loans. And we'll do a question and answer session throughout. Before we begin though, I'd like to ask this question to you out there. Do you know what is the national student loan debt amount? So is it A, $550 billion, B, $862 billion, C, $1 trillion, or D, $1.6 trillion? And if you answered D, $1.6 trillion, you are correct. There's $1.6 trillion in student loan debt here in America. There are over 45 million borrowers, making student loan debt the second highest debt category in the US behind mortgages. So let's take a look at the different types of student loans available to you. There are three main types of student loans that you can apply for. Number one, there's your federal student loans. This is the Fed government who owns the majority of all student loan debt in America. There are state-sponsored student loan plans, and there are private student loans that you can apply for. Now, it's important to note that with federal student loans, there are two types of federal student loans available to you: subsidized and unsubsidized student loan debt. So what's the difference? With subsidized student loans, the government pays the interest as accrued while you are in school. And with an unsubsidized federal student loan, the interest accrues while you are in school and will be paid first once the repayment period begins 6 months after you leave school. It's important to know what kind of student loan you are applying for and what the terms and conditions of that student loan is. Now, when you're applying for student loans and you're taking on debt, and this doesn't even go for just student loans, but for any kind of debt that you're incurring, you have different options and availability to you, and you need to take a note of your interest rates. So with student loans, you have the ability to apply for a variable rate or a fixed rate student loan, and those rates can range anywhere from 3 to 13%. Now, there are pros and cons of applying and taking on a variable versus fixed rate. Now, a variable rate means that your monthly payment on your student loan can change month to month. So as rates change with the Fed government, so can your student loan payment change. Now, at the fixed rate, you are guaranteed a fixed interest rate each month, so you know every month what your student loan payment is going to look like. Now, typically, variable rates have been lower and usually are lower than what your fixed rate, your fixed interest rate on a student loan is going to be. It's also important to know that when you're making a variable rate monthly payment, you can make your minimum monthly payment, let's say it's $200 on your student loan at a variable rate. You can actually go in and make interest only, or you can make a principal only payment on your variable rate student loan debt. Now, as we take a further look at interest rates here, your interest rate is going to be determined by your credit score and or if you have a cosigner on it. Now, why is this important? So when it comes down to applying for any kind of debt, especially student loans, and you want to get the best interest rate you can on there. So you're paying more towards principal than you are towards interest, right? So if you have a lower credit score, let's say you're in the 500 to 600 credit score range, that's a pretty low credit score. You're going to have a higher monthly payment. You're going to have a higher interest rate on your student loan debt. Okay, now the higher your credit score, the lower your interest rate on your student loan is going to be. You're going to be actually, every monthly payment is going to be going more towards principal than it will to interest. So now, why is it important to look for a cosigner? So let's say you're a young person, a young college student, and you've got a decent credit score and you're applying for a student loan. Now, maybe you qualify for an 8% interest rate on your student loan. Now, maybe, so you can get it on your own at 8%, but maybe you have a family member or a parent or guardian or somebody who wants to help you out and be a cosigner on there who's got a higher credit score than you. It's okay to have them as a cosigner if they're willing to be. And you might end up getting a much lower interest rate, in the 4 or 5, 6% area. So it's okay to have a cosigner. You are still liable for making that monthly payment, and it still goes to boosting your credit score. So you might want to look at having a cosigner, adding a cosigner to your student loan just to get the better interest rate. And it's always important to pay attention to changes in the rate environment, especially when you are operating under a variable rate student loan. Okay, and I'll add a little caveat to that right now. We are in the United States is in historically low interest rate environment. Interest rates are the lowest they've been ever in America. So right now would be a good opportunity to look at using the variable rate student loan option for you. And here's another important note: the repayment period begins 6 months after you leave school, whether or not you graduated. So if you're going to be incurring this debt, make sure that you're actually working towards something that you can achieve and will be using in your future. So why should I worry about student loans? So why I need to worry about student loans? So let's look at this question here. So student loan debt, 2019 snapshot. What percent of college students take on debt? Is it A, 19%, B, 37%, C, 54%, or D, 72%? And it looks like we're about even here. What's the answer? The answer is C. 54% of college attendees take on debt, including student loans to pay for their education. Over half of the college attendees in school right now are using student loans to help pay for their education. Now, why is this important? Well, let's just take a look at the growth of student loan debt trending in America right now. So these numbers are in trillions. So from 2014 to 2019, U.S. student loan debt has grown from $1.06 trillion to almost $1.5 trillion over the last 5 years. So if you are part of this statistic, it's important to know what your options are for paying for your college experience and how to pay off your college experience when you graduate. Now, one of the most important components to be aware of when you're taking on student loan debt is how you choose to repay your student loans. So this graph right here represents 3 different repayment periods, including 3 different interest rates. This will help give you a visual representation of how much student loan debt can affect your life. So let's just take for an example here. The blue bar represents a 4% interest rate on your student loan. The orange bar represents 8% interest rate on your student loans, and the gray bar represents a 12% interest rate on your student loan debt. Now, if you choose to go, let's just say, we're going to take the blue bar for an example here. 4% interest rate on your student loan, and you want to pay it off in 10 years. Your goal is to pay off your student loans in 10 years. Your monthly payment at that point is going to be $405, and over the life of the loan, you will be paying $48,698 in student loan debt. Now, if you choose to kick it out and say, hey, I want to lower my monthly payment, I want to kick it out an extra 5 years, so I'm going to go with a 15-year repayment plan. Well, it's going to lower your monthly payment amount to $298. So instead of paying $405 a month, you're only paying $298 a month. But now, over the life of the loan, you'll be paying $53,258 on that same student loan. Now, let's say you want to kick it out even further and lower your monthly payment amount. And let's go 20 years. So now your monthly payment goes from $405 over 10 years or $298 over 15 years. At 20 years, your monthly payment is going to be $242. The amount of money that you're going to pay on that student loan debt over the life of the loan is $58,174. So from 10 years to 20 years, if you want to pay an extra $10,000 to the debt holder, then that's your option. But it's really important to know exactly what the repayment period looks like for you when you're paying off your student loans. And just remember that rates and payments will vary depending on if you have a variable or fixed rate student loan. So you can decide, you can see how long you decide to repay your student loans, and you can see the effect that it will have on your financial future and your quality of life moving forward. So then the question comes, would you rather pay or would you rather be paid? And do I need a student loan? Well, there's a few different options in paying for school, okay? And I'm just going to share my own personal experience with going to school. I went into school with the intention of graduating from college and having 0 student loans. And so by doing that, I decided to join the United States military, and I took advantage of the GI Bill. When I got out of the military, I used that GI Bill and I went to work for a company who offered a tuition reimbursement program. And I also took advantage of some different scholarship opportunities that were available to me. So I was able to graduate from college with 0 student loan debt, and I took advantage of in-state tuition by going to UAA here. Some other opportunities for you for paying for school. There's the work-study program. So FAFSA has a great opportunity for you to work and network and gain experience with people who are in your similar field of study. You can look at different scholarship opportunities that are available to you. So whatever major study you are in, look for resources based on that major. There's many opportunities out there for you that you can use. There are a lot of great community engagement organizations who love to help put people. Look at your local Lions Club. Look at your local Rotary groups. Look at your Chamber of Commerce. There's many more organizations out there who are willing to help their people from their community get through college. And just do a little Google search online. You look for different types of scholarship opportunities. You actually may find something that you would have never even thought of. And here's a little pro tip for when you're paying for college. So break down your semester costs into monthly costs. And you can even further break that down into your weekly costs. But this is typically one of the scenarios that I work with people in private one-on-one settings. So we say, okay, let's look at how much this is going to cost you over 5 months. This is how much it's going to cost you week to week. This is how much it's going to cost you day to day. So breaking down your weekly and monthly and daily expenses is going to really help give you an idea of how much money you have available for you to spend. This will help save you money a lot of money in the long term. Some other opportunities for paying for school. There are grants out there available to you. Federal Pell Grants. There are industry grants, again, depending on which industry that you decide that you want to work in. There are many grants out there who want to help people go through school. So a lot of these companies, organizations, they are looking to help educate the future workforce in those industries. So there are many grant opportunities available to you. Professional development grants, tuition reimbursement programs, like I mentioned, through your employer. And make sure that you know what the terms are of those grants are. So a lot of these grants, it's going to depend. Grant scholarships, it's going to depend. They want to make sure that you are holding a certain GPA. They want to make sure that you're on track to graduate when you tell them that you are going to graduate by, because again, they are looking to fill their workforce with smart, educated people who are considered an expert in their industry. So make sure that you know your terms when you're applying for these grants, and make sure you're working towards that. Oh, I have student loans. What do I do now? All right, so this is another group of people. So it's important to know that if you're carrying student loan debt, that you're using the money in the manner that it's supposed to be used, okay? So if you get a student loan check for $6,000 and your qualified expenses for that semester is $4,000, make sure you return the other $2,000, okay? This is not an opportunity for you to go out there and buy a $2,000 laptop and say, hey, I need this for college, right? This is something I need for my whatever class it is you're taking. So we wanted to share this little bit of information here with you, the difference between what is considered a qualified expense and a non-qualified expense. We pulled this directly from the irs.gov website, and there's the source right there. You can go ahead and take a look at what the government describes as a qualified versus non-qualified expense. Qualified expense includes tuition, textbooks, and required student fees. So if your tuition, textbook, and required student fees equals $4,000, you give a check for $6,000, pay the $4,000 to your qualified expenses, return the other $2,000. Okay? A non-qualified expense includes room and board, insurance, medical expenses, transportation, and any other type of personal living or family expense. So your car, your gas, your expenses it's not considered a qualified expense when it comes to using student loans. Neither is your room and board. That's a completely different category of expense for school. So it's important to know which expenses are qualified and non-qualified. So if you have incurred student loan debt, just make sure that you know that you are not alone. Many college students and adults are in the same boat as you. And this is a pretty impactful note right here, that over almost 15% of adults right now walking around in America are carrying student loan debt. Now, why is this important? I'm going to share a little story here with everybody right now. So years ago when I was working at Wells Fargo and I was going through a certain training program with about 20, 25 other of my coworkers who were in similar job positions as me, talking to one of my colleagues during a break, and we had graduated from schools here. We graduated from high schools here locally in Alaska in the same year. She had decided that she wanted to go to a very prestigious school in California, and she decided to take on student loan debt to help pay for that college experience. And like I said, for me, I decided that I didn't want to be in debt to anybody when I go to school. That's one of the reasons I decided to join the military and work for an organization who would help pay for my schooling and give me the same opportunities. So we're sitting there talking, and we shared the same job title. We were the same exact age, and she had over $150,000 in student loan debt that she was paying on. So she told me she was stuck doing the job that she was doing to help pay off that debt that she was in. You know, I told her my position. I did the in-state tuition thing. I stayed here locally. I used scholarships. I used the GI Bill. I used the tuition reimbursement program, and I have zero student loan debt. And we were sitting there talking, and I even asked her, I was like, in hindsight, would you do anything different? She said, I would do everything different. But for me at that point in time, when I was 17 years old applying for colleges, it was really important for me to go to this school here. But now that I look back on it, I wish I had made a different decision. Opportunity cost for incurring student loan debt to go to the school that you want to has huge impact on your future. Make sure that you are using the money, what it's earmarked for. Make sure that you're actually paying for an experience that is going to be beneficial to you in the future. A lot of people will incur student loan debt and it gets them sucked into a job that they're stuck at, that they don't want to be at, and that they have to stay there to make sure that they can pay off their bills. Like I said, a majority, it's over 99% of all student loan debt is backed by the federal government, which means there is no way in hell you are getting out of your student loan. So you've got student loans. Let's look at some tips for getting out of some debt, huh? Now, these tips for getting out of student loan debt actually work for every other type of debt you might have. If you have got credit card debt, housing debt, car loans, whatever, we're going to use some of the same principles for getting out of your student loan debt. So when we're talking about finance and anything financial, the number one concept to understand is cash flows. All right, so finance is all about cash flows. It's either directing cash flows to certain things to either pay down debt, investing for your future, or whatever it is. Right? But number one, you've got to make sure that your cash flows are working for you, not against you, and you're working with your cash flows. When you're looking at paying off a student loan, the number one thing you need to do is create a loan payoff goal. So tell yourself, I am going to pay off this student loan here within 5 years. Okay. And then at that 5 years, make sure that you are setting a reward for yourself. So if you've always wanted to go to Europe, plan a 2-week trip to Europe. Okay. Say, if I pay off this student loan within 5 years, I'm going to Europe because I can take all the money that I was paying every month towards my student loan debt. I can go ahead and have this trip. Create a goal and work towards that goal each week, each month, each year, and get rid of that student loan debt. And the most important thing, reward yourself for your hard work. So make sure you're adjusting your spending plan, okay? So I always hate the word budget, okay? Budget implies that you're actually restricting. It's like a diet. You're restricting food that you want to eat. When you're budgeting, you're restricting how you spend your money against things that you actually like to do. So I like to work with a spending plan, right? So instead of restricting yourself, you're going to spend your money. You've worked your ass off, right? You've gone to school, you busted your butt, you stayed up late, you've done your cramming sessions, right? You've done your midterms, you've done your finals, you've done it all. Okay, so you've earned that time to spend your money wisely. Adjust your spending plan accordingly and cut out the unnecessary charges. That's always super important when it comes to cash flow, is that your spending plan is in alignment with what your goals are. Okay, so make a lunch. I know I went to college. I know there's a Subway right there. I've been to that Subway many times, and it's so easy just to go in there and swipe your debit card and pay $8 or $9 for that 6-inch sub club sandwich and chips and a soda. I've been there, done it, but you know what? I've also seen my bank account deplete pretty quickly. And bring a lunch to school, bring a lunch to work. All right, you're going to save a lot of money by just making a lunch. Skip that store-bought coffee and make it at home. I love Starbucks too. I treat myself to a Starbucks on the weekends. Every single day of the week, though, I'm making my coffee at home. Okay, so and it's these little things, these little habits like making lunch and making your coffee at home. They add up over time, right? It's compound interest, it's time value concept of money. It's all those little things, those little habits that add up over time that make all the difference in the world years down the road. So again, when we're talking about cash flows here, what are you doing with your free time? Are you looking to do a side hustle? Are you sitting around playing video games? Or are you actually creating a cash flow for yourself? So what COVID has taught us is to get creative with cash flows, right? So do a little side hustle, make deliveries. There's DoorDash. Instacart is a great way to make a little money on the side. You can be an Uber or Lyft driver. Create those extra cash flows and direct those cash flows to paying down your student loan debt. So if you're in school right now and you're accruing student loan debt, go ahead and pay that student loan debt off now. It's all about cash flows, okay? So school payments. So if you had to take out a student loan, make sure, like I just said, you're paying as you go through school. So go ahead and take out that student loan. Do your little side hustle right there. Direct your cash flows. Pay down that student loan debt. Let's say you actually incur. So I think the average American carries about $38,000 in student loan debt. So as you're paying, as you're going through school, if you're doing your little side hustle and you're working, make sure you're paying off your student loans while you're in school. And you might be able to graduate college with having zero debt, which would be fantastic. So again, use those smart cash flow tactics and pay those student loans off before you graduate. And here's an important note: pay the unsubsidized loans first, because the government is paying the interest on the subsidized loans for you. Okay, so make sure if you're carrying those two different types of loans, pay the unsubsidized loans first. Important note. In future success. So if you're out of school and you're carrying student loans, what do? Right? So avoid incurring more debt and pay off your student loans first. So I know it might be tempting. You've graduated college and you've got this great major, and all of a sudden you went from making no money and incurring debt, and now you're making $40,000-$50,000 a year. And you say, hey, I can take on a $300 monthly payment on a brand new car. Don't buy the brand new car. Right? Don't go into car debt just because you can afford it. Right? Buy the used car. All right? Live beneath your means. Pay off your student loans first, and then move forward. Okay? You will have many, many years ahead of you to go ahead and enjoy the new Tesla Model 3 out there. If you're out of school, look for employer compensation packages. So here's a really interesting note right now. So you can negotiate student loan payoff with potential employers. So if you're interviewing and you've got 2 or 3 employers that you're in negotiations with about working for, just ask them. They're not going to offer it to you, but I guarantee you, if you bring it up and ask them about paying off your student loan, say, hey, I will work for your company for 3 years, 4 years, or 5 years if you pay off $20,000 of my student loan. You put that on the table, they will negotiate that with you. Okay, and good employers who are looking for smart employed workforce will enter those negotiations with you. The answer is always no until you ask. So always ask, hey, I've got a student loan, I want to pay it off. Will you help me pay it off as part of my compensation package? 99% of the employers out there will talk to you about that. So we've talked about other debts. So if you do have other debts, there's a couple different ways to pay off debts, but the one way that I really like to use and recommend is the snowball method. Okay, so what is this snowball method? So what you want to do is you want to write down all your debts from the smallest to the largest balance. Okay, and then what you're going to do is you're going to pay off that small amount first. Okay, and there's psychology behind this. Okay, it's the theory of momentum. Okay, so if you're putting everything behind paying off this small amount here, let's say it's only $500, get it paid off in 2 months. Your goal is paid off in 2 months. You're directing all of your cash flow to paying off this $500 or $800 debt, and you get it done. Now you take that amount of money that you just used to pay that off, move it to the next one. Let's say it's $1,500, and you get that paid off in 6 months. You keep that momentum going. It just builds momentum. You build it. It's the snowball effect. It's just momentum. So once that's paid off, once each debt is paid off, you just continue to roll that full amount into the next debt. And just like building debt can build incrementally, so can paying it off. Snowball debt I have found works the best for people. It's just psychologically it works like a charm. And there's other ways. I know a lot of people say pay off the high interest rate stuff first and then worry about the low interest stuff later. That makes sense. In my experience, I've seen the snowball method work much, much better. And then a lot of people ask the question, hey, should I consolidate my student loans? And the answer for everybody is it depends. Okay, so this is why this is personal finance, because it's personal to everybody. Your situation might be different from the situation of the person sitting next to you. So you can consolidate into lower payments, but that might also change the interest rate. So you need to be aware of the terms of your loan. Federal direct loans can be consolidated together, but not with state or private loans. So that's important to know. And with a few exceptions, you only get one chance to consolidate government loans. So before you pull the trigger, you want to make sure on consolidation, you want to make sure that your consolidation is the right thing for you. So know what kind of loans you have and know what those options are. Consolidating could cause you to lose the benefits of certain programs such as public service loan forgiveness. And so if you're unsure or unaware of what your options are, feel free to reach out to me or any other financial service professional who can help you with that. Any other questions? We have some resources at the end of this webinar that you can use to look at what your options are. So I get this question quite a bit, especially when I'm talking about any kind of debt service. They ask me, Travis, should I be investing while I'm paying off my student loans? A lot of people say, I don't have any money to invest. I can't save for retirement. I've got to pay off my student loans. I got to pay off my mortgage. I got to make my car payment. I hear every excuse on why they shouldn't be investing. So the question, should I be investing while I'm paying off my student loans? The answer is unequivocally yes. And I'm going to show you why. Again, so I'm going to refer back to the time value concept of money, okay? And let's take a look at investor one. She's the smart lady in blue, and investor number two, and he's the guy in orange who maybe got a little later start in life, okay? So investor one, let's call her Sally. So Sally starts investing at age 25, right? And so she is investing, setting aside $5,000 a year for 10 years in a row. And she decides to quit investing at the age of 30. And you can see from 25, her investment from 25 and going to 34, her money is going to grow by the age of 65. She's going to have $787,000 at the age of 65. And this is assuming an 8% interest rate compounded annually on her investment. And just so you know, a little side note, if you're investing in the S&P 500, the annual average is 12 to 15%, but that's also compounded daily, not annually like this is. So that's a very conservative rate of return at 8%. Investor number two, he starts investing at age 35, and he's investing the same amount of money. Instead of 10 years, he's going for 30 years in a row until he reaches the age of 65. You can see he's only going to have $611,000 at the age of 65. So starting to save later in life is going to hurt you in the long run. Okay, so get started now. I don't care if you've got 10, 15, 20 bucks at the end of the month. I'm actually going to change that. I tell each and every single person I work with, pay yourself first. That's my number one rule with working with clients is I always tell them, pay yourself first. So if you're working for a company and you're going through college or you're out of college and you're still working for a company, make sure you're taking advantage of your 401k and investing in your 401k. Set aside some money in your savings account, set aside some money in your Roth or traditional IRA, and then make sure that you're paying off your debt, okay? Always need to pay yourself first. And this graph right here is the exact reason why you need to be paying yourself first. If you start saving money at the age of 20, you could be a millionaire by the time you hit 60, okay? Because she quit investing at the age of 34. Just imagine if she had kept investing at $5,000 a year all through her 40s, 50s, and 60s, she would be a millionaire, okay? So start investing now. So like I said, if you're working for a company and you've got a 401k, take advantage of that 401k plan. Take advantage of your IRAs, okay? Start now. Time value concept of money is the most important part. So that concludes today's webinar. So as you can see, student loans may seem like an easy solution, but they have an immense impact on your financial future. And like I said, that's why personal finance is personal. It's different for everybody. So what might be right for one person is going to be different for another person. So it just depends on your situation. Make sure you're speaking with a professional. If you don't know who your professional resources are, well, just look at which webinar you're watching. We'd like to open up the floor to any questions. Does anybody have any questions they would like to ask?
Looks like we have one question in the chat from Heather. She asks, your money in the 401k cannot be invested in a Roth IRA, right? They are separate accounts.
Yeah, that's correct. So the 401k is your company sponsored retirement plan. So that is offered through your employer. And then your IRA is going to be your individual retirement account. So that's going to be through whichever custodian you choose to use, Charles Schwab, TD Ameritrade, Vanguard. They both have their tax benefits. One of the great things about the 401k is you can take advantage of the employer match. A lot of employers will match up to 6%. So I always ask people, hey, do you want a 6% raise? I'd say, yeah. I said, you're investing in your 401k, your employer will match it. Now, usually the follow-up question to that is, what if I've left my employer and I've got this old 401k sitting around, I don't know what to do with it. You can actually roll that old 401k from your old employer into your IRA. But you can actually sometimes roll it over into your new employer's 401k, but I usually recommend against that. Roll it into your IRA and start saving in that manner. Great question. Thanks for asking that one. Do we have any more questions out there?
I think that's it on the questions. If there's any more questions, you can leave a comment on our Facebook live stream, and then we'll provide our contact information at the end of this presentation.
All right. So again, here's that resources page that I was talking about. So here's some great general information and websites you can go visit, and a great student loan repayment investment calculator that you can use and used for this presentation as well. This will be available somewhere, I'm sure. And I would just like to say thank you for attending the webinar tonight. And most importantly, I'd like to say thank you to Solomon and Sarah for helping make this presentation webinar possible and all their hard work and dedication. So big round of applause to Solomon and Sarah. Thank you guys. And really appreciate you guys attending. And there's my contact information. If you have any questions or follow-up you'd like to ask, feel free to reach out to me anytime.